There are two kinds of financial risk. Most people are only afraid of one of them. The first is the risk of losing money. The second is the risk of not growing it. The first is visible, dramatic. It shows up in red numbers on a screen and produces a physical sensation of loss that research shows is twice as powerful psychologically as an equivalent gain. The second is invisible, quiet. It compounds in the background of a savings account at 0.4%, while inflation runs at 3%. And it produces no notification, no red number, no emotional signal that anything is going wrong. So here is the question this video is going to answer. Why is the way you think about risk keeping you poor? Not because all risk is good, not because caution is wrong, because you have been optimizing to avoid the visible risk, the one that feels dangerous, while the invisible risk compounds against you every single month. Stay with this one, because the third risk, the one about timing, is the one that tells you how much of the window for calculated risk you still have. 3 risks, 1 reframe, starting now. The first risk, avoiding financial risk, does not eliminate risk. It guarantees a different one. Here is what most people mean when they say they want to be safe with their money. They mean they do not want to see it go down. They do not want the account balance to be lower next month than it is this month. They do not want to open a statement and see red numbers. They do not want to experience the feeling of having made a financial decision that resulted in a visible loss. That is a completely understandable preference. It is also a misunderstanding of what financial risk actually is. Putting $50,000 in a standard savings account earning 0.4% annually feels safe. The balance does not go down. The statements show steady, predictable increases. Nothing triggers the alarm response that a market drop would produce. But here is what that safety actually looks like in real terms. Over 10 years at 0.4%, your $50,000 grows to approximately $52,000 in nominal terms. Meanwhile, inflation at 3% annually reduces the purchasing power of that $52,000 to approximately $38,700 in today's dollars. You did not lose money on paper, but you lost $11,300 in purchasing power, guaranteed. Not as a possibility, as a mathematical certainty, built into the difference between your savings rate and the inflation rate from the moment you chose the account. The safe choice was not the absence of risk. It was the choice of a different risk, slower, invisible, guaranteed, over the visible risk that made the safer feeling option feel preferable. Now ask yourself directly, how much of your capital right now is sitting in accounts earning below inflation? Not approximately. Look at the actual rate. Whatever that amount is, multiply it by the gap between your savings rate and 3%. That is your annual guaranteed loss in purchasing power. That is the cost of the safe choice. The first risk, the guaranteed one. Safe is not the absence of risk. It is the choice of a slower, invisible, guaranteed loss over a visible, manageable one. Most people are avoiding the wrong risk. The second risk, you are overestimating the risk of investing and underestimating the cost of not investing. The safe account is costing you. That is the first risk. But the second risk explains why most people stay in that account anyway, and why the fear driving that decision is built on a distorted picture of what investing actually involves. Here is what most people believe about stock market investing: that it is inherently unpredictable, that it is possible to lose everything, that the stories of people who got wiped out in crashes represent what investing is. Here is what the historical data actually shows. The S&P 500 has produced positive returns in approximately 75% of all calendar years since 1928. In rolling 10-year periods, any 10 consecutive years, starting any year in that span, it has produced positive returns approximately 94% of the time. In rolling 20-year periods, any 20 consecutive years, it has produced positive real returns 100% of the time in recorded history. 100%, including the Great Depression, including the 2008 financial crisis, including every crash, correction, and recession the market has survived and recovered from. Over a 20-year horizon, the horizon most mid-career professionals still have, the historical probability of losing real purchasing power in a diversified market portfolio is effectively 0. Now compare that to the savings account. The probability of losing real purchasing power in a savings account earning below inflation? 100%. The risk profile most people are running, high perceived risk of investing, high comfort with savings accounts, is the inverse of what the data supports. The investment that feels risky has produced positive real returns over every 20-year period in history. The investment that feels safe has a guaranteed negative real return at current savings rates. What financial decision are you currently deferring because it feels too risky? And when is the last time you calculated the guaranteed cost of that deferral? The second risk, the perceived one, the market feels risky and cash feels safe. The data says the opposite over any meaningful time horizon. You are insuring against the wrong outcome. The third risk, the window for calculated risk, narrows every year you wait, and the cost of missing it compounds. The first two risks explain the problem and the misperception. The third tells you what to do and how much time you actually have left to do it in. Here is the variable that changes everything about financial risk: time. At a 5-year investment horizon, historical data suggests approximately a 30% chance of a negative real return. That is real risk, meaningful, worth accounting for. At 10 years, approximately 12%. At 15 years, approximately 5%. At 20 years, approximately 2%. At 25 years, effectively 0. Risk is not a fixed property of an investment. It is a function of time. And at mid-career, with 20 to 30 years ahead of most people reading this, the actual statistical risk of a diversified market investment producing a real loss is not the terrifying number the fear suggests. It is close to 0. But here is what makes timing the third risk rather than just a reassurance. That 25-year window is not permanent. Every year you wait to act, every year the capital that could be compounding sits in an account earning below inflation, is a year removed from the left side of your investment horizon. At 40, you have approximately 25 years before traditional retirement age. At 45, you have 20. At 50, you have 15. The probability of a negative real return at 15 years is approximately 5%. The probability at 20 years is approximately 2%. The probability at 25 years is approximately 0. Every year of deferral moves you up that probability curve. Not dramatically, not catastrophically in a single year, but compounding in both directions, the investment that was not made and the risk profile that has quietly increased. As we covered in why playing it safe was the poorest decision you ever made, the window for calculated risk does not stay open indefinitely. The risk of acting narrows with time. The risk of not acting expands with it. Now ask the question this video has been building toward. What would it take for you to make one calculated financial risk decision this week? Not a reckless one, not your entire net worth in a single position, One diversified, evidence-based, long-horizon investment decision. The kind that 25 years of historical data says produces a positive real return with near certainty. What is stopping you? And what is the annual cost of that thing stopping you? In purchasing power, in compounding, in the years of your investment horizon you are consuming while you wait to feel ready. Every video on this channel starts with why. Why playing it safe was the poorest decision you ever made. Why the stock market is not your path to wealth. Why compound interest won't save you if you start at 40. Every assumption you were handed about what financial safety means, questioned. If this video changed what you call safe, that is exactly where it was supposed to land. Remember this, the window for calculated risk is open right now. It narrows every year. The risk of acting with a 25-year horizon is near zero. The risk of not acting is guaranteed. Choose the risk that at least gives you a chance.